And welcome. It's April 3rd, our second session of the day here on FX Street. Wonderful day to all of you. Thanks for being here. And thanks to everybody who's listening on the replay. We know you're out there. Thank you for listening. Let's see, just a reminder that coming up in a short time, we have the RBC Manufacturing PMI for Canada and the Market Manufacturing PMI for the US, and then the ISM Manufacturing PMI also for the US. So today's Manufacturing PMI day. And what is PMI? It's Purchasing Managers Index. You know, if you think about it, it's a really clever idea. Every company has a purchasing manager. There must be somebody who's in charge of how many pencils, how many computers, how many chairs, how many desks, and etc., right? That every company has. Because let's face it, you know, if you're going to hire people, they have to have a computer and they need a place to sit and, you know, all these things, right? So obviously the purchasing manager knows what is going on at the company. The company has to have all the proper supplies. So if the probably nobody at the company knows better than the purchasing manager everything that's going on and what are the future prospects of the company. Make sense? So the idea is, let's just survey the purchasing managers and let's ask them, you know, what do they think about the economy? Where's the economy heading? Where's the company heading? And if we add together the opinions of all these purchasing managers, maybe that'll give us an idea of where the economy is heading. Does that make sense? That should. It's actually a very clever idea. Wish I'd thought of it, right? It's pretty smart. So anyway, that's why we have days like today where, you know, we're going to get, we've already had the manufacturing PMI for Europe, for Great Britain, and now we're going to get Canada and the US. And when we say manufacturing PMI, we're talking about, okay, there's a purchasing manager for factories, right? And then maybe it'll be tomorrow, right? But usually soon after or before manufacturing PMI, there will be services PMI, right? And that'll be PMI reports for services companies. Now, services PMI, probably more important than manufacturing PMI for most of the countries that we're viewing, right? Because why? Because most of the countries that we trade are services-oriented economies, right? Is Europe a manufacturing economy? Well, Germany is. Germany certainly is. So German manufacturing PMI is very important. All right, here's Germany. Germany came in line. Manufacturing is definitely a huge part of Germany's economy, and Germany's the biggest economy in the Eurozone. So Germany's manufacturing PMI is much more important than, say, Italy's manufacturing PMI or France's manufacturing PMI, right? Do you think China's manufacturing PMI is important? I do, right? China's a huge exporter, and they mostly export things that they make in factories, right? China's not exporting copper or oil. China's exporting items that they make in factories, correct? So China's manufacturing PMI matters. But in the US, I would be more concerned with services PMI. I would be more concerned in Canada with the services PMI. I would be more concerned in Great Britain with services PMI. Does that make sense? As opposed to manufacturing PMI. We're also going to get construction spending out of the US. And we're going to hear from 3 different Fed officials today. They'll probably all contradict each other. Try not to get too tangled up in all that stuff. Fed speak. They've all been saying pretty much the same thing. 3 Fed hikes this year. We've already had 1. So as long as they stay on that track, there's no need to change anything. Most likely 3 rate hikes this year, and the Fed funds bear that out. Fed funds futures, I've shown you from time to time, they bear that out. Okay. Tomorrow, the big number tomorrow, we're going to get retail sales out of Europe, expected to jump 0.5 month over month and 1.4 year over year. That's February retail sales, even though we're in April now. In the US, we're going to get factory orders, expected to increase 1% for February. That's for tomorrow. Let's get back to the charts. As always, if you have any questions or on any topic involving Forex or trading in general, please feel free. Go ahead and ask. That's why I'm here. We talked a great deal about the British pound during the prior segment, and we did a pretty couple nifty setups on the pound US dollar. So we're going to move away from that topic now. I'm going to take a look and see about the euro. Euro broke out above resistance and then fell apart. It's an interesting chart. There was a lot of resistance in the 108 area. You can see that shaded in yellow. It breaks out, and this just goes to show you that it doesn't matter. You could have done everything right here. You could have bought the breakout, and it wouldn't have made any difference. Sometimes markets just don't cooperate. I don't know of any strategy that's 100% effective. If there is one that's 100% effective, then obviously we would simply be talking about that one thing all the time. What is interesting here is there's a pretty big gap. See the close here on March 24th and the open on March 27th. So you have the weekend gap, big gap up, right? And that may have been the Scotland independence referendum. Scotland notified the UK that they wanted an independence referendum vote. Euro jumps over the weekend, and just the gap fills, and just the euro just plunges after that. But if you're trading gaps, this is a classic gap fill. I'll take it to the 60-minute chart. Whenever we're looking at gaps, a lot of traders look for gaps to fill. And let's see if we can go back and find that on the 60-minute. Looks doesn't look quite as impressive here, but it looks like we close on the 24th at 107.96, and we open at 108.37. So it's a 41 pip gap. That's not insignificant, right? That's a pretty significant gap. Normally, I like it to be a little bit greater than that if I'm going to play a gap fill strategy. I like them to be 50 or greater. But in this case, you know, if you played it to fill, that worked. Now, what am I talking about? There's a philosophy that states that when you have a large gap on a chart, a significant gap, that the proper way to play it is to assume that the gap will fill. The gap begins here. Right, this candle, the week closes right here. And the following week opens here. And the space in between, right, the space in between, any orders in between may have been left unfilled. It's possible that you have unfilled orders in between. Now, we don't know how many unfilled orders. We don't know if they're buy or sell orders. But it's entirely possible that there are unfilled orders in here. So they could be big. They could be small. They could be buy, they could be sell. So maybe they're, well, you know, we don't know. Let's say there were some big sell orders, maybe some little buy orders. And there's all kinds of orders floating around in here. But they're unfilled orders. These X's just represent orders. And like I said, they could be, the different colors represent buy and sell. So you don't know what's in there. And even the banks and brokers have limited knowledge because they see their own, they know where their own orders are. But remember, this is not on an exchange. There are various orders in there. But this is not on an exchange. So Goldman Sachs knows where Goldman Sachs' orders are, but Goldman Sachs does not know where JP Morgan's orders are, and vice versa. Everybody knows where their own orders are, but nobody knows where anybody else's orders are. But we know this, banks and brokers make money when orders are filled. And so if the price comes through, let's just say that there's an incentive. We all know that the one thing that they all know, JP Morgan knows, Goldman Sachs knows it, Deutsche Bank knows it, Societe Generale knows it, Santander knows it. They all know that there's a gap. They all know that there's some kind of orders in there. So there's an incentive, right? If the orders get filled, then there are commissions to be earned. Santander knows that they have an order in there to sell. Santander knows it has a sell order in there. One of its clients has a sell order. JP Morgan knows that one of its clients has a buy order, and so on and so forth. Santander knows nothing about JP Morgan's orders. JP Morgan knows nothing about Santander's orders. But everybody knows about their own orders. And all the banks and brokers make commissions when orders are filled. Fair enough? So, if the price comes in, there's a way to play it. A trader can look at this and say, look, I don't know if that price is ever going to come back, but there's a chance that there may be some orders here. So maybe I'm going to sell short if the price enters this area. I'll sell short. I'll put my stop up above, and I'll put my target, one target down at the far end, but another one in the middle. Because let's face it, the middle's a good area to shoot for. I have no idea if there's going to be an incentive to push it all the way down to the end of that zone. Now, the wider the gap, the bigger the gap, the better in this situation. My preference would be, look, I would prefer this gap to be bigger. Bigger gap means more orders are left behind. More orders left behind means a greater incentive for the banks and brokers to give the price a push. Does that make sense? We want them to give it a push. That's what we're waiting for. If they push it into that gapped area, it'll trigger our short. If it never enters the gapped area, we can just cancel the orders. Looks like right about here we'll be selling short. Target 1 is hit. Target 2 right there. So in this case, it looks like it's going to work out. That's certainly not always going to be the case. If target 1 is hit, we bring the stop down to the break-even point. This way we insure against a loss, on the second half of the trade. Lock in a gain. The reason why this gap is likely to fill is because these orders that are left behind represent a missed opportunity for the banks and brokers. If they can just figure out a way to get those orders to execute, then they're going to get paid. They don't care if the client wins or loses. They just want the commission. They assume that the client wants the order to execute. Otherwise, the order wouldn't be there. That's their perspective. So they're not trying to make anybody win or lose. They're just trying to get orders filled. If orders are filled, they get a commission. End of story. So from their perspective, it's all pretty simple. Anyway, that's how you play a gap fill. In Forex, we tend not to get very many gap fills. However, we certainly saw a lot of them last year, didn't we? For example, leading into the U.S. presidential election, we saw numerous gaps in the Mexican peso. That huge gap. By the way, they just couldn't wait to sell short right? Because the polls were saying, well, because the polls were telling them, hey, you got to sell short the US dollar against the Mexican peso. Let this be a lesson. You should never pay attention to the polls. This is November 4th to November 7th, so this is a weekend. That's a huge gap. Boom. And anyone who sold short there, if you held it, you regretted it. Same thing happened with Brexit. A few months before that. Let me take you back to June. I think I may have taken you back too far. Hold on. Here we go. Took you back way too far. Hold on. Okay, so look at the run up ahead of Brexit. Same thing happened. Big gap here. That's on June 17 and then June 20th. Again, a weekend gap. This is a huge rally, by the way. This is like over 600 pips in a week. Huge gap over the weekend. British pound closes on Friday at 143.52. Opens on Sunday, 144.64. So a 100 pip gap here over the weekend. Why? Because the polls say that Brexit can't pass, and boom, they gave that back pretty quickly. This doesn't look like much because that's 1,000 pips here. That's 1,700 pips here, going the other way in one candle. Pretty amazing. Pretty amazing stuff. Really shocking. Okay, so anyway, what do we learn from that? Don't listen to polls, and B, you can play the gaps. Now, the way things are going, you're probably going to get more opportunities in 2017. Will there be a Scottish referendum? Too early to say. There's a decent chance that there will be. We know also, we have elections coming up in France. We have elections later in the year coming in Germany. And all of these could lead to gaps potentially in the euro. So, stay awake we'll certainly talk. Ouch. We'll certainly talk about these the potential for setups in these as these events approach. So, there's going to be opportunities for sure. But just don't be pulled around by. Under any circumstances, you should never be pulled around by polls, because just remember, polls are very often, paid for by groups who maybe want to achieve a certain result, and they might want the poll to come out a certain way. So it's not as if polls are necessarily. Sometimes they're biased. Sometimes the polls are designed to produce a certain result. And I think a lot of traders were looking at these polls as if they were unbiased. They were treating them as unbiased, and they were placing trades as if the polls were unbiased. But we know that polls, are commissioned and paid for by people, and sometimes those people want the poll to come out a certain way. Okay, so just keep that in mind. Okay, so anyway, now you know. Now you know how to play the gap. And the one thing I would avoid when you're using this type of strategy, I would say the most common error that people make is trying to trade a 10 pip gap or a 15 pip gap, which, you know, those type of small gaps are very common on a Sunday evening. And trying to trade that tiny little gap is, it's probably not worth it, because first of all, on Sunday evening, the spreads are wider. So it's almost certainly going to be a losing proposition. You have a much smaller gap, generally speaking, and a much wider spread. So it's going to be a losing proposition almost certainly. So be aware of that. If possible, my preference would be to trade with a tighter spread, which some companies offer a tighter spread. They might use terms like core spread or raw spread, and that might mean paying a commission. But it might be worth it to pay the commission to get the tighter spread. Right? Because a tighter spread is a very good thing to have. There are a lot of times where you're going to be one pip away from your target, and that darn spread is going to prevent you from hitting your target. And having a tighter spread means, yeah, I don't mind paying that commission because it puts me closer to the target. And there are going to be times when that's going to be the difference between winning and losing. This is especially true when it comes to working in tight areas like gaps. Okay, so you will see a difference there. Okay, I hope that helps. I hope that clears a few things up. All right, that's going to just about do it for us for today. I hope you enjoyed the session and our little gap fill strategy. By the way, this type of strategy can also be applied not just to Forex, but to futures trading, to stock trading, really to any form of trading. Gaps do happen in all forms of trading, perhaps less in Forex trading than in others due to our tremendous liquidity. But gap trading is something that does occur in Forex, just not as often as it does in other forms of trading. And now you know how to handle it. Okay, ladies and gentlemen, my name's Ed Ponsi. Thanks for listening. I'll talk to you again tomorrow. Everybody have a wonderful day. Take care.